Every few months, someone says it with total confidence. The market is expensive right now, better wait. Then 6 months later, the market is up 15% and they are still waiting. Here's the problem. Almost nobody who says expensive can actually tell you what they mean by it. Most investors treat expensive as a feeling. Markets have gone up a lot lately, so it must be expensive. Or a market has stayed flat for 2 years, so it must be cheap now. Both of those are just pattern matching on price movement. They say nothing about whether the price is actually justified. A stock or a market can double and still be cheap if what it's earning has tripled. And a market can go nowhere for years and still be expensive if earnings haven't grown either. Price by itself tells you almost nothing. What you actually need is a way to compare price to something else. And that's where valuation actually starts. Check 1. Price needs a partner, earnings. The starting point of any real valuation check is a simple ratio. How much are you paying versus how much the underlying companies are actually earning. This is the idea behind the price to earnings, or PE multiple. If a company earns 10 rupees a share and the stock trades at 200 rupees, you're paying 20 times earnings. On its own, 20 means nothing. Is that high or low? That's why the next step matters more than the number itself. Check 2. Compare today's multiple to history and to future earnings, not just to a headline. PE of 20 might be expensive for a slow-growing, mature business, and cheap for a company expected to grow earnings quickly. So professional allocators don't just look at where the price-to-earnings ratio sits today, they look at where it sat historically for that same market or segment, and, more importantly, they look forward. What are analysts estimating this basket of companies will earn over the next year or two? If earnings are expected to grow meaningfully, a market can look expensive on trailing numbers and still be reasonably priced on a forward basis because the earnings are catching up to the price. Check 3. The idea of fair value versus where we are actually trading. Put those two pieces together, a reasonable multiple and a genuine forward earnings estimate, and you can build a rough estimate of what a market or index should be worth if it were priced fairly. Compare that fair value estimate to where the market is actually trading today, and the gap between the two is a simple, usable signal. If the market is trading only slightly above that fair value estimate, that's a very different situation than a market trading way above it. The size of that gap, not the price move that got you there, is what actually tells you whether something is expensive. Check 4. Small gaps aren't a red flag, big gaps are. This is the part that most people get wrong. A market trading modestly above its fair value estimate isn't a warning sign. A bit of optimism priced in is normal and healthy. The concern only starts when that gap becomes large, when the price has run so far ahead of realistic earnings expectations that a lot would have to go right and quickly to justify it. That's the difference between the market has some optimism baked in and the market is priced for perfection. One is a normal state to invest in. The other deserves caution and usually means staggering your investments over time rather than putting it all in at once, not avoiding the market altogether. Check 5. Valuation is one input, not the whole decision. It's worth being honest here. A valuation check tells you about price relative to earnings. It doesn't tell you about liquidity conditions or how much money is flowing in every month from systematic investors, or where interest rates are headed. Those matter too. But valuation is the piece most investors skip entirely, which is exactly why the market feels expensive ends up meaning nothing more precise than prices went up recently. Here's a simplified, illustrative way to picture it. Treat these numbers as illustrative only, not a live market call. And remember, any historical or estimated figure is not a guarantee of future performance. Say an index is trading at 24,700. Based on realistic forward earnings estimates and a reasonable multiple, your fair value estimate for that same index comes out to 24,500. That's roughly a 1% gap. The market trading almost exactly where the underlying earnings say it should be. Now imagine instead that fair value estimate was 20,000 and the market was trading at 24,700, a much larger gap. The first scenario is a market you can invest into normally. The second is one where staggering your entry over several months is the more sensible approach. Next time someone tells you the market is expensive, ask them, expensive compared to what? If they can't point to earnings, they are describing a feeling, not a valuation. That's what expensive market actually means. Not a gut feeling about how far prices have run, but a measurable gap between price and what the underlying earnings can support. That's it for this one. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.